Hello, I'm Jamie, CPA and co-founder here at Blue Money. Welcome to today's training on profit and loss statements. Here to tell you the basics about what they are, why they are, and a little bit more about how you can use them in your business. I spent 15 years helping business leaders understand their own businesses and make more profit, keep to budget, and make sure their cash flow is all in order. I've worked in all size businesses from publicly listed companies all the way down to startups all over the world. The current economic climate is really tough, and insolvencies are up 40% and still rising. So, if you are serious about your business, you must be monitoring the financial health regularly and not just a once in a year check when your tax is done. Today, I want to help you understand your profit and loss statement for free. Understanding this amazing tool and having it set up correctly will help you identify opportunities in your business, uncover your business story, and hopefully there will be easy to action strategies you can get started with straight away, and it'll help you make more profit over the next few months. Since starting Bloom Money 3 years ago, most of the businesses I chat to are not currently using their profit and loss at all, or very rarely. It's an underrated tool that can help you uncover your business story and really good opportunities in your business. And I'm here to show you how to use it. So let's jump straight in. First of all, what is a profit and loss? A profit and loss is a snapshot of time where we look at your expenses and your revenue in your business. So in accounting, if we take one more step back, we have 5 categories on which we can categorize any transaction into. Firstly, we have assets. An asset is something that you use today that will help generate business in the future and helps your business generate money over a period of time. So, for example, if you need to deliver flowers to people, then a car is an essential item to your business, and that is classified as an asset because it's going to provide us benefits over a period of time. And then a liability is something that we owe. So that could be the loan on the car that we've just purchased to help generate our business. And this also usually happens over a longer period of time. So these kind of transactions are not on your profit and loss statement. And your equity, so that's kind of the net equity, the net worth of your business after you have all your assets minus all of your liabilities, is your overall net position of your business. Still no mention of profit and loss yet. So over this side, our last 2 categories are revenue and expenses. So revenue is our invoicing, our sales that happen in a period of time. And our expenses could be things that directly relate to selling our item. These are our cost of goods sold, or overheads, so that occur over a period of time. So, for example, rent for a month, that is 1 month rent that happens in a period, and that's kind of once it happens, it's done. We have our rent and it's only for that period. It's not going to provide us any future benefits. So it's not an asset, it's an expense. And just like a loan kind of happens over a long period of time. And the loan is to help us and help our business get to a better position. So it's not really a reflection on how my business has done this month. It's a loan, it's a long-term money that I owe. So we've got our revenue and our expenses. And when we have our revenue and we take away our expenses, then we get our profit. So our profit is kind of like a signal of how our business has done in a period of time. So if you're using an accounting software like Xero, you could run a profit and loss for a month and we can see how that business is going in the month. So we should only, on a profit and loss, see the revenue and the expenses related to the month that we're looking at, relating to the profit and loss that we're looking at and the time period. We shouldn't see anything that is outside of that time. So if it's June now and we see our revenue, it should be our sales that happened in June. If you are accounting on a cash basis, you will see revenue that landed in your bank account in June. If you are accounting on an accrual basis, you will see your revenue that you invoiced in that month. So there is quite a difference there, and your accounting software will tell you when you run the report which accounting you're using currently. And if you want to change that, you can, but that is how you can tell what you're doing at the moment. So expenses, they will also be for the month. So if you have prepaid something in advance, like insurance, for example, and you paid 12 months, you wouldn't put that to an expense account. You would go put that to a prepayments account because it's an asset, and an asset that is going to provide you a benefit for the next 12 months. And over the 12 months, you can, we say release 1 month at a time. So each period, each month, you kind of have a profit and loss with one of those 12 insurance installments on it. And that is the way to best represent your figures. And that's the way we're going to tell how our business is doing at any one point in time. So yeah, that is our revenue and our expenses. And that is how we divide each of these things into these 5 categories that we have in accounting. So now you understand what a profit and loss is and what appears on a profit and loss, our revenue and our expenses, and not our assets, liabilities, or equities items. Let's actually have a look at the profit and loss and what it looks like. So here we go. This is what a profit and loss looks like in Xero. So what you can do is run it for a month. This is August 2024. And in this period, we had $17,000 of sales. And in this demo mode, it cost us $763 in purchases of cost of sale items. So that might be purchasing the actual stock. In some cases, it could be related to a contractor if it's a service. I like to put our contractor fees in there if it directly relates to the sale. And then at the end of that, we have our gross profit. So our gross profit just takes into account our sales minus our cost of sales. So that is a really, really important benchmark, important figure that we have to give a good estimate of how our business health check is going. And then under the line, we have operating expenses. So under here, we should have things that are general operating expenses, things like, so you've got light, power, heating, motor vehicle expenses, office supplies like pens and stationery, or general accounting fees. So if you're paying to get your tax done, that would be an overhead that you have to account for, but something that is just accounted for and does not affect the sales. So if I have 1 sale or if I have 1,000 sales, my accounting figure stays the same. And that's the same with most items that sit under the operating expenses. And that's the easiest way for you to tell if it should be up in your cost of sales expenses section or if it should fall under your operating expenses section. So one thing I find is like something like Facebook ads or Instagram ads. For me, I classify always as a cost of sale because it should directly correlate with the amount of sales that I have. If I put an extra $100 into my marketing budget, I should see a return on that investment. And I want my gross profit to reflect that. And I want to make sure if I am spending an extra $500, $1,000 in marketing, I want to make sure my gross profit is staying the same. If you have a marketing retainer, I would put the retainer fee down here and I would put the ad spend up in cost of sales. So that is a way I would use it, and I would use that gross profit number. If you have Xero and you'd like to add in a gross profit percentage so you can actually monitor your percentages, if you just go to edit layout down in the bottom left corner, you can add a column, add a percentage, and select the month and as a percentage of trading income. Update your layout. And now you'll be able to see this. So gross profit in this business is amazing. It's 95%. So that is quite high. If you want to have a look at your benchmark on the ATO website, if you type in small business benchmarks, it will have some benchmarks for your industry and you can compare your gross profit to the benchmark in the industry. But just making sure that you do have all your costs that relate to a cost of sale up there. You can also, if you find something like advertising and you want to put it up in a cost of sale, you can edit again and you can simply drag it up into that section. And the other way that I really like to use this report is you can identify where the problem is. So if you are looking over a period of 4 months, for example, and you say, have gone and changed your marketing budget, what you want to see is you want to have a look at this line. And in August, I can see it's 82. In July, it was 86. And in June, it was 99. So my question is, why is that going down? It's down nearly 20%. So I want to know why. And that tells me the problem that I need to focus on is up above the gross profit line. Whereas if I had seen 82% across the board and my business was in not making a profit, or is the profit was not where I want it to be, I would maybe go to think maybe my problem is below the line. Have my total expenses gone up? Have they gone down? Is something missing? And did something go up that I need to have a look at? And these are the kinds of questions we can have a look at once we've got our profit and loss right. So how many times should you be looking at your profit and loss statement? I think this depends on your business needs, but I would probably try and do it at least monthly because you want to be able to analyze your profit and loss statement and, if needed, make quick decisions, quickly turn things around. So when I was working in publicly listed companies, we had to have profit and loss ready, prepared, into our business leader within 3 or 4 days of the month closing. So that meant, staying back on New Year's Eve, making sure all the sales are in, make sure all our numbers are right. So they were getting accurate figures so they could quickly turn around decisions or changes that needed to be made within the next few months so that next month they are not making those same mistakes. If there's a loss, they can turn that around really quickly. So using those numbers for these kind of things are really important. So from here, the profit and loss is one of the most important statements. And the other two for next time is a balance sheet, which will show the other categories we were talking about, your assets, your liabilities, and your equity. So your balance sheet shows those. And then while your profit and loss will show just revenue and expenses. And then the other statement that's super important is your cash flow statement. And a cash flow is kind of a mix of everything. We show, it doesn't matter which category we're in, it's really like the money in, all the money in, all the money out. Because sometimes if you're feeling like you're a bit strapped for cash, but you're making a profit, sometimes the problem's over on your balance sheet. So sometimes your cash flow statement will kind of help you dig down into that. And maybe you have too many loans, or we need to try and consolidate in another way over there. The other things that are really important for your integrating all your reports is finding some key metrics, some KPIs that you want to set. So whether that is your gross profit margin and you want to monitor that, or is it your total expenses percentage? Is it that? Or is it your revenue per person? So having a little think about which performance metrics you really want to be monitoring over the next few months will help you create a plan and in the right direction. And budgeting and forecasting is another tool that you can use your profit and loss for. You can set some future goals, your future profit for the year, and we can kind of work backwards from there. So I'd really highly recommend using your profit and loss to create a plan for the next 12 months. And whether you use Xero to do that, or if you just do it in a spreadsheet, which is totally fine, I would highly recommend doing that. Because if you fail to plan is a plan to fail. So making sure you're on plan on all the time is really important. The final part of this I really want to highlight is when your profit and loss is right, your tax is right, it makes your tax bill correct and your decision making based on the correct information and your financial health. But tax preparation is really key. I personally had a story where I was given a $40,000 tax bill, and only because I knew my numbers did I know that tax bill was wrong. I did not owe $40,000 at all. I had already paid it all, and they were trying to tell me that I had another $40,000 to pay. Once I got my hands on the workings and I was able to look through the numbers in the detail, I was able to pinpoint the exact lines that were incorrect and know, and then give that back so I didn't have to pay. So preparation is key. Profit being correct and the accuracy of your bookkeeping is absolutely key to making sure your tax is correct. Do not rely on your tax accountant to get this right for you. Their job is not to check over the bookkeeping. They are only checking your numbers against tax legislation and then making the tax calculation based on that. They assume that your bookkeeping has already been done correctly. So if you need help with that, make sure you stay tuned, follow our socials, and we'll hopefully have more on this soon.